Welcome to SD Panthers Market Insights. I'm Farah, and today we have a very special deep dive episode.
Thanks, Farah. We're doing a comprehensive 25-minute analysis of Home Depot. Ticker symbol HD. This is one of the most important retail stocks in the market. And we're going to cover everything you need to know.
Absolutely. Home Depot is the largest home improvement retailer in the United States. With over 2,300 stores and a market cap of approximately $380 billion. Today we're going to break down their financials, competitive position, growth strategy, and whether this is a buy, hold, or sell opportunity.
Let's start with the current stock price and recent performance. HD is currently trading around $385 per share, which represents a significant premium to where it was trading just a few years ago. The stock has been a consistent performer. But there are some headwinds we need to discuss.
That's right. Let me give you the bearish perspective first. Home Depot is facing several challenges. First, the housing market has cooled significantly. With mortgage rates above 7%, home sales have declined, which directly impacts Home Depot's business since most of their revenue comes from home improvement projects tied to home sales and renovations.
I see that point. But let me counter with the bullish view. While the housing market has slowed, Home Depot has a very resilient business model. They serve both professional contractors, who represent about 45% of their sales, and do-it-yourself customers. The professional segment is more stable and less dependent on housing turnover.
That's a fair point about the professional segment. However, I'm concerned about their valuation. HD is trading at a price-to-earnings ratio of around 22, which is above the market average. Their forward PE is even higher at about 24. This suggests the stock might be overvalued, especially given the current economic environment.
I understand the valuation concern. But let's look at their earnings quality. Home Depot has consistently grown earnings per share over the past decade. They've increased EPS from around $5 in 2015 to over $16 in the most recent fiscal year. That's compound annual growth of over 12%. Which is exceptional for a mature retailer.
The earnings growth is impressive. I'll give you that, but I'm worried about margin compression. Home Depot's operating margins have been under pressure due to increased labor costs, supply chain expenses, and competitive pricing. Their gross margin has declined from about 34% to around 33% in recent quarters.
Margin compression is a concern. But Home Depot has been investing heavily in their digital capabilities and supply chain efficiency. They're spending over $1 billion annually on technology improvements, including their One Home Depot strategy, which integrates online and in-store experiences. These investments should pay off in the long run.
The digital investments are necessary, but they're expensive, and I'm concerned about their debt levels. Home Depot has increased their long-term debt significantly, from around $12 billion in 2019 to over $40 billion today. That's a substantial increase. And with interest rates rising, their interest expense is going to climb.
The debt increase is primarily due to their share buyback program. Home Depot has been very aggressive with buybacks, reducing their share count by over 20% in the past 5 years. This has been a major driver of their earnings per share growth. The debt-to-equity ratio is still manageable at around 2.5, which is reasonable for a retailer.
Share buybacks are good for shareholders, but they're not sustainable forever. Eventually, they'll need to pay down that debt or reduce buybacks. And I'm concerned about their dividend yield, which is currently around 2.4%. That's decent, but not exceptional, especially when you can get similar yields from less risky investments.
The dividend yield might not be the highest, but Home Depot has an excellent track record of dividend growth. They've increased their dividend for 15 consecutive years, and the dividend growth rate has averaged over 20% annually. That's exceptional dividend growth, which is more important than the current yield for long-term investors.
Dividend growth is nice, but I'm more focused on the business fundamentals. Let's talk about their same-store sales growth, which has been slowing. In the most recent quarter, comparable store sales were down about 3%, and that's a concerning trend. If this continues, it could signal that Home Depot is losing market share or that the overall market is shrinking.
The same-store sales decline is a concern, but it's important to put it in context. We're comparing against very strong comps from the pandemic period when home improvement spending was elevated. The 3-year stack, which compares to pre-pandemic levels, is still positive. Home Depot is essentially normalizing from the COVID boom.
I understand the normalization argument, but I'm seeing signs that the home improvement market might be in a longer-term decline. Consumer spending is shifting away from home improvement toward experiences and services. Younger consumers, especially millennials and Gen Z, are less likely to own homes and therefore less likely to spend on home improvement.
That's a demographic concern, but I think you're underestimating the aging housing stock in America. The average age of homes in the US is over 40 years, and as these homes age, they require more maintenance and renovation. This creates a natural tailwind for Home Depot's business regardless of new home sales.
Aging housing stock is a valid point, but I'm concerned about competition. Lowe's has been gaining market share, and they're investing heavily in their stores and digital capabilities. There are also new competitors like Amazon entering the home improvement space, which could pressure margins further.
Competition is always a concern, but Home Depot has significant competitive advantages. They have the largest store network, the best supply chain in the industry, and strong relationships with professional contractors. Their Pro Extra loyalty program has over 5 million members and drives significant repeat business. These are moats that are difficult for competitors to replicate.
The Pro Extra program is strong, but I'm worried about their online presence. While they've invested in digital, their e-commerce sales are still only about 10% of total revenue. Compare that to other retailers who are doing 20 to 30% online. If they don't accelerate their digital transformation, they could lose market share to more digitally native competitors.
The online percentage might seem low, but Home Depot's omnichannel strategy is actually quite sophisticated. Many of their online orders are picked up in store, which drives foot traffic and additional sales. Their Buy Online Pickup in Store program has been very successful, and it's a competitive advantage that pure-play e-commerce companies can't match.
That's a good point about omnichannel, but I'm still concerned about their growth prospects. Home Depot's revenue growth has slowed significantly. In the most recent fiscal year, revenue grew only about 1%, compared to double-digit growth during the pandemic. Without strong revenue growth, it's hard to justify the current valuation multiple.
Revenue growth has slowed, but that's expected after the pandemic surge. The key is that Home Depot is maintaining profitability and market share. They're also expanding their addressable market through initiatives like their MRO, or maintenance, repair, and operations business, which serves commercial customers. This is a $100 billion market opportunity that they're just beginning to tap.
The MRO opportunity is interesting, but it's still early days and unproven. I'm more focused on what's happening right now. Let's talk about their inventory levels, which have increased significantly. Higher inventory means more working capital tied up and potential markdown risk if demand doesn't materialize.
Inventory levels have increased. But that's partly intentional. Home Depot is building inventory to ensure product availability, which is crucial for their professional customers who need materials on demand. They've also been expanding their product assortment, particularly in categories like tools and appliances, which require higher inventory levels.
Higher inventory for availability makes sense, but I'm concerned about the cash flow implications. Home Depot's free cash flow has declined in recent quarters due to higher capital expenditures and working capital requirements. Free cash flow is the lifeblood of dividend payments and share buybacks. So this is something to watch closely.
Free cash flow has been impacted by investments. But these are growth investments that should pay off. Home Depot is spending on store remodels, supply chain improvements, and technology. These are necessary investments to maintain their competitive position. Once these investments are complete, free cash flow should improve.
I hope you're right about the investments paying off, but I'm skeptical. Let's talk about their international expansion, or lack thereof. Home Depot is almost entirely focused on North America, with only a small presence in Mexico. This limits their growth potential compared to companies that have successfully expanded globally.
The lack of international expansion is actually a strength in my view. Home Depot tried to expand internationally in the past, most notably in China, and it didn't work out. By focusing on North America, they can maintain operational excellence and avoid the execution risks that come with international expansion. The North American home improvement market is large enough to support significant growth.
That's a fair point about execution risk, but it still limits their total addressable market. Now let's talk about their supply chain. Home Depot operates a very complex supply chain with thousands of suppliers. Any disruption, whether from natural disasters, trade issues, or supplier problems, could significantly impact their business.
Supply chain risk is real. But Home Depot has one of the most sophisticated supply chains in retail. They operate 18 distribution centers and have invested heavily in supply chain technology. They also have strong relationships with suppliers and have been working to diversify their supplier base to reduce risk.
The supply chain is sophisticated, but it's still vulnerable. Let me shift to a technical analysis perspective. Looking at the chart, HD has been in a downtrend since early 2023. The stock broke below its 200-day moving average and has been struggling to regain momentum. This suggests that institutional investors might be reducing their positions.
Technical analysis shows weakness. But I think this is more of a consolidation phase after the strong run during the pandemic. The stock is finding support around the $350 level, which represents good value for long-term investors. This could be an attractive entry point.
I'm not so sure about that support level. If the housing market continues to weaken, HD could break down further. Let's talk about option strategies for those who want to play this stock. For bearish investors, I'd recommend a bear put spread. Buy a put option at a strike price of $380 and sell a put at $360. This limits your downside while giving you exposure to a potential decline.
For bullish investors, I'd suggest a covered call strategy. If you own the stock, you can sell call options against your position to generate income. With HD's dividend yield and the option premium, you could generate a total return of 5 to 7% annually, even if the stock doesn't move much.
Covered calls work in a sideways market, but if the stock declines, you're still exposed to the downside. Now let's dive deeper into their financial metrics. Home Depot's return on equity, or ROE, is around 1,200%, which is extremely high. However, This is largely due to their high debt levels and share buybacks. The return on invested capital, or ROIC, is a better metric, and that's around 35%, which is still very strong.
The ROIC of 35% is exceptional and shows that Home Depot is very efficient at deploying capital. This is one of the highest ROIC figures in the retail sector. It demonstrates that management is making smart capital allocation decisions, whether it's store investments, technology, or share buybacks.
High ROIC is good, but I'm concerned about sustainability. As the company matures and growth slows, maintaining that high ROIC becomes more difficult. Let's talk about their balance sheet. Home Depot has current assets of about $30 billion and current liabilities of around $22 billion, giving them a current ratio of about 1.4, which is healthy but not exceptional.
The current ratio is adequate. And more importantly, Home Depot has strong cash generation. They typically generate $15-20 billion in operating cash flow annually, which gives them plenty of flexibility to manage their working capital and debt obligations.
Cash generation is strong, but let's look at their capital allocation. Over the past 5 years, Home Depot has spent about $50 billion on share buybacks and $8 billion on dividends, compared to only $12 billion on capital expenditures. That's a very shareholder-friendly approach, but it comes at the cost of reduced financial flexibility.
The capital allocation has been very shareholder-friendly, which is why the stock has performed so well. But I agree that they need to balance buybacks with investments in the business. The good news is that management has indicated they'll be more balanced going forward, with increased investment in growth initiatives.
I hope management follows through on that, but I'm skeptical given their track record. Let's talk about their management team. CEO Ted Decker has been with the company for over 20 years and took over as CEO in 2022. He has deep operational experience, which is good, but I'm concerned about whether he can navigate the current challenging environment.
Ted Decker's experience is actually a strength. He's been through multiple economic cycles with Home Depot and understands the business deeply. His operational background should help the company maintain efficiency and profitability even during difficult times.
Experience is valuable, but I'm concerned about innovation. Home Depot has been slow to adapt to some trends, like the shift toward sustainable products and services. Younger consumers are increasingly focused on environmental issues, and Home Depot might be missing out on this trend.
That's a valid concern. But Home Depot has been making progress on sustainability. They've committed to reducing their carbon footprint and have been expanding their selection of energy-efficient products. They're also working with suppliers to improve the sustainability of their supply chain.
Those are good steps, but they're still behind some competitors. Let's talk about their store format. Home Depot operates large format stores, typically around 100,000 square feet. These stores require significant real estate and are expensive to operate. As e-commerce grows, these large stores might become less efficient.
The large format stores are actually a competitive advantage. They allow Home Depot to carry a wide assortment of products and provide services like tool rental and installation. The stores also serve as distribution centers for online orders, making them more efficient than pure e-commerce operations.
That's a good point about stores serving as distribution centers. But I'm concerned about their real estate costs. Home Depot owns about 90% of their store locations, which is good for long-term cost control. But it also means they have a lot of capital tied up in real estate.
Owning real estate is actually a strength. It provides stability and protects against rent increases. Home Depot's real estate portfolio is worth billions and provides a valuable asset that could be monetized if needed.
Real estate ownership is valuable, but it's not very liquid. Let's talk about their customer base. Home Depot serves both DIY customers and professional contractors. The professional segment is more profitable because professionals buy in larger quantities and are less price sensitive. However, the DIY segment is larger and drives more foot traffic.
The mix of DIY and professional customers is actually ideal. The professionals provide stability and higher margins, while the DIY customers drive volume and store traffic. This diversification makes Home Depot's business more resilient than if they focused on just one segment.
The diversification is good, but I'm concerned about the DIY segment. As younger consumers delay homeownership, the DIY market might shrink over time. This could force Home Depot to rely more heavily on the professional segment, which is more competitive.
The DIY market might change, but it's not going away. Even renters do home improvement projects, and as people age, they often become more interested in home maintenance. Home Depot is also expanding their services business, which can serve both DIY and professional customers.
Services expansion is interesting. Home Depot offers installation services for things like flooring, windows, and appliances. This is a higher margin business that can help offset some of the pressure on product margins. However, it's still a relatively small part of their overall business.
The services business is growing and represents a significant opportunity. Installation services have higher margins and create customer loyalty. As Home Depot expands this business, it could become a meaningful contributor to both revenue and profitability.
Services could be a growth driver, but it's still unproven at scale. Let's talk about their pricing strategy. Home Depot has been very competitive on pricing, which is good for customers but puts pressure on margins. They've been matching or beating competitor prices, which is expensive but necessary to maintain market share.
Competitive pricing is necessary in retail, but Home Depot has been able to maintain margins through their scale and efficiency. Their large buying power allows them to get better prices from suppliers, which helps offset some of the competitive pricing pressure.
Scale helps, but I'm still concerned about margin pressure. Let's talk about their product categories. Home Depot's sales are spread across multiple categories: building materials, garden, tools, appliances, and more. This diversification is good, but some categories are more cyclical than others.
The product diversification is a strength. When one category is weak, others can pick up the slack. For example, when new construction slows, repair and maintenance categories often remain strong. This helps smooth out the cyclicality of the business.
Diversification helps, but it doesn't eliminate risk. Let's talk about their geographic concentration. Home Depot is heavily concentrated in the United States, with about 95% of their sales coming from the U.S. market. This makes them very dependent on the U.S. economy and housing market.
The U.S. concentration is a risk, but the U.S. home improvement market is massive, worth over $400 billion annually. Home Depot has plenty of room to grow within the U.S. market without needing to expand internationally. The market is large enough to support significant growth for years to come.
The U.S. market is large, but it's also mature. Let's talk about their competitive position versus Lowe's. Lowe's is Home Depot's primary competitor, and they've been gaining market share in recent years. Lowe's has been investing heavily in their stores and has been more aggressive on pricing.
Lowe's is a strong competitor, but Home Depot still has the larger market share and better profitability. Home Depot's focus on professional customers gives them an advantage, as professionals are less price sensitive and more loyal. The competition is healthy and keeps both companies focused on execution.
Competition is healthy, but it's still a risk. Let's talk about their technology investments. Home Depot has been spending over $1 billion annually on technology, including their One Home Depot platform, mobile apps, and supply chain technology. These investments are necessary but expensive.
The technology investments are paying off. Home Depot's mobile app has over 10 million downloads and drives significant online sales. Their One Home Depot platform integrates online and in-store experiences seamlessly. These investments are creating competitive advantages that will pay off over time.
Technology investments are important, but they're also risky. Technology changes quickly, and what's cutting edge today might be obsolete tomorrow. Home Depot needs to keep investing just to stay current, which is expensive.
That's true. But Home Depot has the scale and resources to make these investments. They're not trying to be a tech company. They're using technology to improve their retail operations. This is a more sustainable approach than trying to compete directly with tech companies.
I hope you're right. Let's talk about their ESG, or environmental, social, and governance factors. Home Depot has been making progress on sustainability, but they still have work to do. Their carbon footprint is significant due to their large store network and supply chain.
ESG is important, and Home Depot has been making progress. They've committed to reducing their carbon emissions and have been expanding their selection of sustainable products. They've also been working on diversity and inclusion initiatives. These efforts are important for long-term sustainability.
ESG progress is good, but it's still early. Let's talk about their risk factors. Home Depot faces several risks: economic downturns, housing market weakness, competition, supply chain disruptions, and more. These risks are significant and could impact the stock price.
All companies face risks, but Home Depot has proven resilient. They've navigated multiple economic cycles and have maintained profitability and market share. Their strong balance sheet and cash generation give them flexibility to weather difficult times.
Resilience is good, but it's not guaranteed. Let me give you my overall assessment. I think HD is a hold at best, and potentially a sell if you're looking for growth. The stock is expensive, the business is facing headwinds, and there are better opportunities elsewhere in the market.
I respect your bearish view, but I think HD is a buy for long-term investors. The company has a strong competitive position, excellent management, and a proven track record of creating shareholder value. The current weakness is a buying opportunity for patient investors who can wait for the housing market to recover.
We'll have to agree to disagree on that, but let's give our listeners some key takeaways. For those considering HD, I'd say wait for a better entry point, perhaps around $350 or lower. The stock is not cheap, and there are headwinds that could push it lower.
My takeaway is different. I think HD is a quality company trading at a reasonable valuation given its growth prospects and competitive advantages. For investors with a 3 to 5 year time horizon, I think HD offers good value here, especially with the dividend yield providing downside protection.
One final point: keep an eye on housing market data. New home sales, existing home sales, and housing starts are all key indicators for HD's business. If these metrics continue to weaken, it could be a sign to stay away from the stock.
Absolutely. Housing data is crucial. But also watch Home Depot's quarterly earnings reports. Pay attention to same-store sales, margin trends, and management's guidance. These will tell you if the company is executing well despite the challenging environment.
Great point. And don't forget to consider the broader economic picture. Interest rates, inflation, and consumer confidence all impact Home Depot's business. If the economy enters a recession, HD will likely struggle along with other consumer discretionary stocks.
That's true. But Home Depot has proven resilient during past economic downturns. They've maintained profitability and market share even during difficult times. Their focus on professional customers and essential home maintenance needs provides some insulation from economic cycles.
We've covered a lot of ground today. To summarize, Home Depot is a well-run company facing some headwinds. The stock is not cheap, but it's not extremely expensive either. For investors, it comes down to your time horizon and risk tolerance.
I agree with that summary. HD is a quality stock that deserves a place in a diversified portfolio. The current price offers reasonable value for patient investors. And the dividend provides income while you wait for the housing market to recover.
That's a great way to wrap it up. Thanks for joining us for this deep dive into Home Depot.
Thanks, Farah. And thanks to all our listeners. Make sure to subscribe to SD Panthers Market Insights for daily market analysis and more special episodes like this one.